Welcome everybody to TradeStation. My name is Michael Burke. I head up client education here at TradeStation. I want to welcome you to another edition of our options trading series. Today's event, Critical Option Pricing Factors, is hosted by Ed Modla of the Options Industry Council, and we'll get to Ed in just 1 minute. Please keep in mind that the following presentation is for educational purposes only. All of the symbols and trading ideas discussed by the instructor are for educational purposes and not recommendations. Active trading is not suitable for everybody. Options trading, doubly so. Take a look at the TradeStation website for additional disclosure information, and we're going to push some disclosure information and a link into the chat. If you're looking to get up to speed on TradeStation right now, TradeStation Securities is hosting a daily training channel, getting started with TradeStation on the youcantrade.com website. Every day there's something new to learn. You can ask questions, watch archived videos on all the TradeStation platforms. Check it out for free. And once you're ready to take your trading to the next level with TradeStation, you can subscribe to our new online masterclass. Now you can get all the same great advanced training that we offer in our in-person masterclass from the comfort of your home or office. And you get access to all the same great resources, special events, and you can check it out for free right now for 14 days. As I said a little bit earlier, our presenter today is Ed Modla of the Options Industry Council. He's a senior instructor there. He's an expert in all things option and is just an outstanding educator, and it is always great to have him with us on these events. So Ed, I'm going to stop sharing and I'm going to turn it over to you.
Thank you very much, Michael. It's glad to be here as always. And just a little bit about my background. I started in the business way back in 1997, so going on 23 years in different capacities. My initial introduction to options was day one on the trading floor in Chicago in the trading pits, and I'll invoke some of those experiences and the things that I learned a little bit throughout the presentation today. But for the last 5+ years, I've been with the Options Industry Council, focused on providing education to retail investors and money managers, giving presentations like these, traveling to conferences, and teaching classes. And I really enjoy networking with not just options traders, but those who are interested, really anybody that's interested in managing money and doing it on their own, teaching them about the options product. Here is our disclaimer. Options are not suitable for everyone. It certainly takes a deep understanding and some study and thorough knowledge of the product before you use it in a live account. About OIC, we were founded in 1992. Prior to that, the exchanges were not so comfortable with some of the myths and misunderstandings about the options product. They wanted an entity to provide unbiased, free education, and the Options Industry Council was formed. So 28 years. The OIC has been in existence. Most of the education you can find on our website at optionseducation.org. You can also contact the investor services team by email if you have any questions about what we have to offer. The email is there, options@theocc.com, and I'll put this contact info back up at the end of the presentation. Here's the outline for today. Many investors think that pricing models and Greeks are advanced study. And I'm certainly not going to say they're very simple. It would be helpful to any listeners or viewers out there to have some level of basic options knowledge. But a lot of what I go through today is rather simple and can be understood by anybody. I think there's something in here for investors of all skill levels. I'll start talking about the industry in general, with supply and demand and where prices come from, then walk through a little bit on the models. You may not have walked through the math behind the models. I'll do a little bit of that and then walk through the Greeks, definitions, commentary, and explanations of what the Greeks are. By and large, this is going to help you understand where options prices come from, and maybe just as importantly, understand when you notice or observe options prices change in the open market, why did those changes occur? It's a common question for investors to be uncertain. Why did my option value change from this to this? I don't understand why, and the Greeks can certainly help you do that. Before getting to the pricing models, first and foremost, options prices are derived from all market participants. That's you, me, money managers, institutional investors, anybody that is putting up a bid or an offer into the market. They are setting the price. And the market is always trying to find that equilibrium level where, as there's more bids and more buyers coming into the market, the price is being driven higher. And if there's more sellers and offers coming into the market, the prices are drifting lower. The market's constantly trying to find that level where everyone's happy with where the price is, and there's no buying and selling going on, and you have a nice bid-ask spread. But of course, that doesn't happen too frequently. There are price movements because the demand and supply is driving prices in both directions. And ultimately, that is where prices are set, from supply and demand. The pricing models that we're going to walk through in the coming slides are really just ways to help gauge or to develop theoretical values for what you think an option might be worth, or to help guide you in deciding whether an option might be overpriced or underpriced. But the models don't derive factual numbers. The output is simply theoretical in nature. And speaking of those models, there's all sorts of things that you have to put in before you can get the output. Most of them are known numbers. Everybody knows what the stock price is trading at right now, what strike price you're trying to place a value on. Volatility is the one piece that is completely uncertain. No one knows exactly what volatility should be because we're looking forward. These are options contracts. The volatility assumption is going to analyze the expected volatility between today and expiration date. And that's an uncertainty, and it's constantly changing. So that is the unknown piece that makes options trading so interesting and sometimes volatile. Moving forward, time till expiration, everyone knows how many days until the expiration date, and the risk-free interest rate, the cost of money, specifically the risk-free interest rate between today and expiration date. How much can you earn on your money? Those are all components known except for that volatility number. If you do plug in all of the above, including a volatility assumption, you get an output of call and put premiums, which again are theoretical values, sometimes called theos for short, or hypothetical values. Now you can solve for volatility. I'll get to that in a few slides. If you want to analyze what is the volatility in today's marketplace, looking at this as an equation, you can input stock price, strike price, days till expiration, cost of money, the interest rate, and an option value, and then solve for volatility. So those are two different ways that you can use the pricing models. By far and away, the most popular and well-known pricing model is Black-Scholes. Before I put the actual math up on the screen, a little context is helpful. Let's go back to the most important year in the options industry, 1973. That's when CBOE listed options contracts for the first time with standard terms that allowed investors to buy from one counterparty and sell to another, or that made the options product fungible, you might say. But also prior to 1973, not only did you have over-the-counter trading where you were tied to a counterparty, but also investors didn't quite know how to price options. Even though they were a significant part of the investment community, the investment portfolios of this industry, over-the-counter trading had a lot of uncertainty attached to it. So 1973 not only had the exchange launch with listed options contract, but it had the publishing of a pricing model which helped investors gauge where they think an option might be worth. It helped place some clarity around what an option price should be or could be trading at given the relevant inputs. Now, I started out as a math major in college, and I didn't stay there for a reason. And I switched over into business, so I could not dissect, take apart, and put back together this formula. But looking at a few pieces is rather interesting, and I just want to walk through a couple of them. First of all, this is Black-Scholes calculating the value of a call option. And there's really two terms here. First of all, you have this ND1 times the stock price. S as you see here in the legend, is the spot price of the underlying asset, or the stock price. You have this first term, then you have this second term here, ND2, we'll get to that in a second, times the strike price. K is the strike price of the option, and this here is just discounting to the present value of the strike price. So that's really it. Now, just as at a snapshot, ignoring ND1 and ND2, you can see call equals stock minus strike. And you can already notice how as the stock moves higher, that's going to have a positive influence on the call option price. That makes sense. Now, what are these factors, ND1 and ND2? They're really probability factors that are attached to each side. And I'm not going to walk through all of this, but as we all likely know, volatility is a major component in the options industry and with the pricing of options. So this last bullet point down at the bottom, sigma is the volatility of returns. Let's just look and see, where is sigma? It's not here. It's in D1 in two places. It's down here in the denominator, that's sigma there. And then it's also up here in the numerator, sigma squared, which is also known as variance in the numerator. And you can just see, because it's squared up here in the numerator, that an increase in volatility is going to increase the result of D1, which increases the result of this first term, ND1 times the stock price. If volatility goes up, this term will increase. What about D2? You have sigma over here. You take the value of D1 and you subtract sigma times this time component. If volatility is increasing, D2 is going to decrease. So this term will decrease in value as volatility goes up. The net effect, if this term is going up and this term is going down, is call prices go higher as sigma or volatility goes up. And that's what we'd expect to happen. Now, deeper analysis of these formulas is something most investors aren't going to do. Just looking at the two pieces I outlined, I think is rather interesting for those of you who are mathematically inclined. You may want to take it to another level and do more analysis on Black-Scholes, but just looking at those pieces gives you an idea of how the formulas use what we all understand, even from the most basic level of options pricing, and calculates the options values. Now, there are certain assumptions that have to be made when a model is going to work. With Black-Scholes, it assumes that we're talking about European options. That means options that can only be exercised at expiration. Well, equity and ETF options are not European, they're American. More on that in a second. Also, volatility is a constant. That's an assumption. Of course, that is not true in the real world. Volatility is changing all the time. But for a pricing model to calculate a value, it has to have a volatility assumption, and that volatility assumption has to be assumed to be correct between today and expiration date. Also, log normal, for those of you, again, who are a little more mathematically inclined. This is in contrast to a normal distribution. Normal distributions are symmetrical, expecting the possibility of equal moves up or down. Log normal is a little different because it isolates only positive numbers. And we are talking stocks and index values here, which cannot be less than 0. So with no negative values, you have this skewed log normal distribution of returns that is used within the pricing model. Back up to the top, I said European options. Well, what about those American options that can be exercised early? Quite commonly, this model is used, the Cox-Ross-Rubenstein model that was published some number of years after Black-Scholes, which is a binomial model frequently used to price American-style options. And I'll explain it this way. Binomial is rather labor-intensive. If you start out with a stock price of 100, the binomial model assumes, well, it can go up or down from 100, maybe up to 101 or 99. And those two numbers, 101 and 99, would be the first step of the binomial model. But then you can look at each of those two numbers and say, well, it can go up from 101 to 102, or it can go back down from 101 to 100, or from 99, it can go up or down. And now you have step 2 with more possible stock values. And you can go out further, step 3, 4, 5, and the stock values that are possible start to branch out into this much, much longer list. Well, what this model can do is isolate each of those circumstances and then determine if one of those circumstances or a number of them would result in early exercise. More specifically, as it calculates an options value at each of those circumstances, some of those values will be less than the intrinsic value of the option itself. When those circumstances are identified, the model will assume early exercise takes place. It'll increase the value of the option from its theoretical to the intrinsic value, and now you've incorporated the American style exercise feature looking at those early exercise possibilities. So Cox-Ross-Rubenstein is used largely for American style options, and you can use calculators. Certainly walking through the math is not something investors generally do. You can use calculators that are offered in a number of places, including our website at optionseducation.org. And we have one that's very similar to others. I'll just walk through. You can put in any stock symbol you want. Choose the exercise style, American or European, and that's going to dictate which pricing model is used. And then all of the inputs. Again, here you have volatility. You'll have to put in a volatility assumption which has some degree of uncertainty to it. And then hit calculate. Once you put all this in, you calculate the call and put prices up and down. Now, what's interesting about this is you can then go back and change some of these values. If you're trying to forecast, well, what might happen to the option value if the stock moves in a week to a different level? Well, you can change the price of the stock to wherever you want, change the days to expiration, but then maybe forecast out, well, at various volatility levels, given the new details of stock price and days to expiration, what will the net effect be on my options prices? And this is a great way to either learn or to forecast out what options might be worth in the future as circumstances change, understanding all along that there is going to be a level of uncertainty with those results. Now, I also want to point out what we have here at the bottom. If you want to work backwards, if you remember when I talked about the inputs, volatility is something you can solve for. That's what this does. Given the inputs, if you want to enter a call price or a put price and then calculate, this calculator will show a result of what volatility is associated with that options price. There's different things you can do here, certainly for trading around earnings, and you want to put in volatility today and then look, well, after earnings, I know volatility is coming down. I have no idea how far. You can lower volatility, change the stock price, and start to get a feel for what the option price is going to change to. What'll be interesting there is if you do move the stock up a little bit, but drop volatility significantly and hit calculate, you'll start to learn, as many investors sometimes learn the hard way, that if you buy call options prior to earnings and the stock moves up, the call option value might still decrease because volatility has gone down. And if you're not familiar with all these inputs, that's something that may catch you off guard if you're starting to trade options, but understanding all of this, how it works and how to calculate can certainly be helpful. So there's a couple things we went through there. First of all, ultimately, where do prices come from? What matters most is supply and demand. All market participants, all bids and offers, that is what is setting the price. The models can help estimate what an option might be worth given certain inputs and can help you forecast what an option might be worth in the future. Within that, now we're moving on to the Greeks. And the Greeks, I'm going to say, the first thing I always say when I teach Greeks is that most investors who are trading options are doing some form of Greek analysis whether they know it or not. If you're looking at the price of your option and evaluating at least a little bit whether or not you think it's too much, or whether or not you think it's a good value to purchase, or whether or not there's enough time left in this option, you're doing Greek analysis and you might not even realize it. It often comes down to just understanding the terminology. And it's just the words themselves that can sometimes be daunting. And I'll get through these definitions with commentary later, so I won't go through them now. But here are the first order Greeks, these 5 that I'll go through one by one. And this is a nice summary page. There'll be another one when I'm through with going through these 5 that detail just the most simple definition of what each of these Greeks represents. Before I get to delta, let's just have a few words about Greeks themselves. First of all, they're only useful during the lifetime of the option prior to expiration. Of course, that's rather obvious. At expiration, an option's value is simply its intrinsic value if it has any. Option Greeks and time value and extrinsic value does not play a role at expiration. And the Greeks are fluid. We'll walk through some numbers here today, but the Greeks change all the time, not just because the stock moves or there's macro or microeconomic forces in the market changing things, but Greeks can affect each other. As delta, as time to expiration changes, as the stock moves, as volatility changes, delta can be changing because of those factors as well. I'll also talk a little bit about moneyness. For those of you not familiar with that term, moneyness is the in the money status of the option. Is it in the money, at the money, or out of the money? That's the moneyness of an option. And the Greeks behave differently depending on where that sits, and also expiration date. Each of the Greeks has a formula. There's math behind it, but for the most part, investors are not concerned about how to do the calculations. It's more a matter of understanding how to read them and how to use them with your investment decisions. For the most part, investors are still concerned with what you would expect them to be: choosing the right stock, having the right analysis, implementing the right strategy, managing the position appropriately. And then when it comes to options, it's understanding the price that you're seeing, the price that you're paying or receiving when you sell, and the changes in price moving forward. Understanding all of that is really paramount, and the Greeks help you do that. If you're wondering, where do I find these things? Really, any brokerage firm can have the Greeks listed. This is from our website. Entering any stock symbol, you get the strike price. And then here's implied volatility followed by the Greeks. I will talk about implied volatility, but by itself, IVOL is not a Greek. It is very important. That's why I'll get to it later, but not a Greek itself. Here they are. And on your brokerage platform, this is likely columns that you would have to filter for and tailor the display to your liking. So let's start with what might be the easiest one to understand. The most popular Greek that's out there is delta. As the stock price moves, the price of the option is going to move. We understand that. So how much is it going to move? There's a way to forecast what we might expect the new option price to be as the stock changes. And delta helps us do that. It's the expected change in an option price for each 1 point move in the underlying. And moneyness matters. Deep in the money options will behave with a very high correlation to the stock price itself. Think about extreme situations. And before I get into that, when I learned options over 20 years ago, one of the most valuable pieces of advice I was given is when you're trying to understand a concept or trying to wrap your arms around an idea that's explained to you, think of an example and push that example to an extreme level, even an unrealistic level. And when you do that, the answer starts to become much more clear. And I'm going to do that a little bit here, thinking about delta with respect to an option's moneyness. If you have a stock that's trading at $100 a share, and you're looking at a call option with a strike price of $10, you'd expect that option to be worth about $90. If the stock went to 101, the option is probably going to follow suit and move up to 91. and follow 1-for-1, having an extremely high delta of 100%. 100% of the move of the stock is going to be observed in the options market. On the far other end of the scale, staying with stock at 100, let's say we're now looking at a call option with a strike price of 300. If the stock moves from 100 to 101, we wouldn't expect the price of that 300 strike call to change at all, if any. So the out of the money option have low deltas. The further and further you go out of the money, deltas approach zero. And that makes sense. We would expect those far out of the money options to just not change very much at all as the stock price moves. Now I want to break out calls versus puts and talk positions being long and short. Calls have positive deltas because there is a positive correlation to the stock price change. As the stock moves higher, call prices are influenced higher and deltas are going higher as well. And as the stock price drops, call prices go down and call deltas also go down. Positive correlation is long deltas. If you purchase a call option, you now own an option that has long deltas, meaning your position is long delta. You want the stock to go higher because you want to make money with that stock moving up. So you have this positive correlation. You're buying deltas, you're long delta. If you sell a call option, someone else is buying the long deltas, you're selling them to them. So your position becomes short delta. As the stock price moves up, that's going to work against you. You don't want the price to go higher. You sold this option. Short deltas will profit with the stock price moving down. As the call price and deltas move lower, that's in your favor. You sold an option that's worth a certain amount. You want the price to go down. Short deltas, from a directional perspective, profit with stock prices moving lower. So buying calls is long deltas. Selling calls is short deltas. Now let's look at puts. It's just as simple to understand just from the opposite direction. Put prices move in the opposite way that stock price movements occur. So there's a negative correlation, and put options themselves have short deltas. Now let's think, if you buy a put option, you own short deltas. You are buying an option that has short deltas, you own it, meaning you want to profit on the stock moving down. Stock moves down, the put price goes up, that works in your favor. You're short deltas, and that makes sense. If the stock moves up, the put price goes down and the delta goes down, and that works against you, and that's short deltas. Now, what about selling puts? Again, same explanation as before. If you sell a put option, you're giving someone else the short deltas, and you are taking on the long deltas. Long deltas are going to profit as the stock price moves up, and as the stock price moves up, put prices go down. That's good for the seller. Prices contract. You're making money, so you have short deltas. You have long deltas in your position when you sell put options. So to wrap that all together, buying calls is long delta, selling calls is short delta, and buying puts is short delta, selling puts is long delta. And those are the four outright positions. That's all you can do. If you're bullish on a stock, there's two things you can do. You can buy calls or sell puts. Those are the long delta trades that you can take on. Buy call, sell put. Now you can combine those in different ways, use different expiration dates, different strike prices, different quantities, but those are the two things you can do. If you are bearish, you want short deltas. The two ways to get short delta: selling calls or buying put options. Now you can combine buying and selling. Let's just look at a vertical spread real quick. If you are bullish and you want to buy a call spread, stock's at 105, maybe you buy the 110 calls and you sell the 115 calls. You are buying long deltas at the 110 strike. You're selling short deltas at the 115 strike. The net difference between the two is going to be long delta because the lower strike call has the more deltas attached to it. So there's all sorts of ways you can put together long and short positions on calls and puts and end up with a net delta position simply by adding all of them up. Long delta is bullish and short delta is bearish. As I said, the stock movement is going to have an effect on delta. Volatility changes can have an effect, but also changes in time will have an effect. In the money options become more sensitive and will behave just like the stock as time approaches, and out of the money options become less sensitive. Just looking at the example, sticking on the top half here, just looking at calls. Now, stock price is at 60 with 18 months to go. At the 60 line, the delta approaches 50. It's at the money and it's going to approach 50 as we go from 18 months down to 1 month. Now let's look here at the bottom. The in the money call, the 45 strike, starts with an 85 delta, but as we get closer to expiration and the stock stays at 60, this in the money call is going to approach 1 and approach positive full correlation with stock price movements. Moving out of the money, the 75 strike, it's out of the money. As the stock moves, there's a delta here. A year and a half out, there's a delta. If the stock goes from 60 to 61, this option value might change by 38 cents. But as you get closer and closer to expiration, now we're 1 month out. If the stock goes from 60 to 61, well, that's still pretty far away. With only a month left, that has almost no effect on the option price at all. So very low deltas as you get closer to expiration. That's just a nice snapshot of looking at how, as time changes, even if the stock doesn't move at all, just as time changes, you can see changes in the delta of an options contract. Now, when I learned options over 20 years ago, one of the definitions that I was taught was that delta represents the probability of an option finishing in the money, or a 70 delta call has a 70% chance of finishing in the money. A 30 delta call has a 30% chance of finishing in the money. Now, this is a definition that is not mathematically precise, but it is widely accepted and understood to be useful. And I would say most investors use this sometimes as a guide when they're trying to evaluate strike price selection. If you're a seller of options, for example, I hear investors say, well, I like to sell 40 delta calls or 30 delta calls or 20 delta calls, or same thing on the put side. It could be a starting point to evaluate what strike price you want to use. And I'll just clarify here, if you're looking at a 30 delta call and trying to interpret that as a 30% chance of finishing in the money, that's what the market is indicating. And that's a fair assessment of what the market is telling you. Your own proprietary market analysis may tell you something completely different. And you might think there's a much greater or less chance of an option finishing in the money than what the market is telling you. An important part of clarification here, moneyness, in the money, out of the money, does not have anything to do with profitability. Profitability, P&L, is simply the difference between what you paid for an option and what you sold it for. In the money status has nothing to do with it. You can buy a 70 delta call thinking, hey, this got a 70% chance of finishing in the money. And even if it does finish in the money, you still might end up with an option worth less than you bought it for. So make sure you separate those two in your mind. Moneyness and an option finishing in the money does not equal profitability. Profitability is more simply the difference between what you're paying and what you're selling for. So now as the stock moves, I said the delta is going to change. If the stock's at 100 and we're looking at a call with a strike price of 100 and all of a sudden the stock goes to 110, the delta is going to be different. In fact, the delta is constantly changing as the stock moves. It would be helpful or useful to know or forecast what that change is going to be. And that's what gamma is trying to do. It's delta's sensitivity to the stock price. It's a numeric value that is trying to estimate how much delta is going to change as the stock moves by $1. It is the adjustment, or sometimes called the acceleration, of delta as the stock moves. Now, just as we walked through with the deltas of calls and puts, let's do the same thing for gamma. Now, given a certain stock and expiration and strike price, gamma is the same for calls and puts. There's no difference at that line, at that specific strike price, for calls and puts. Now let's think about gamma for calls here. As the stock price goes up, we would expect the delta to go higher. We can push it to an extreme. Stock's at 100, and we're looking at a strike price of a call option at 150. Well, that delta is going to be 0. What if the stock goes all the way up to 200? Well, that delta is going to be 100. Goes from deep out of the money to deep in the money. So it increases as the stock goes up. Now, for each dollar, the gamma amount is trying to forecast how much is that going to be. As the stock price drops, the delta goes down by the gamma amount. This is rather simple. And for puts, as the stock goes up, we know put deltas are going to go down. They'll move from in the money to out of the money or further out of the money status and approach 0. And as the stock price drops, the delta of a put option goes up by the gamma amount. Now, what is it? Now, first of all, if you're buying options, you're buying gamma. It's the same for calls and puts. Buying either a call or a put is long gamma, and selling options is short gamma. You're looking for movement if you're buying options, and you are looking for a lack of movement if you're selling options. Buyers want the movement in the stock to work in their favor, and they want gamma, and they want delta, and they want all of that to offset any losses they may incur with the passage of time or time decay. So gamma, buying options is long gamma, selling options is short gamma, and it doesn't matter whether it's calls or puts. Now, one other thing I want to say about gamma before we move into theta is it's greatest close to expiration and for at the money options. That's what we're trying to represent here with gamma. The actual gamma amount and the stock price, the stock's at 60, you have the greatest fluctuation in delta with the at the money strikes, and then very little fluctuation in delta when you go in either direction, far in or far out of the money. Another way to look at that is here, looking at delta in the bottom graph with the stock price at 60. Now here you have great changes in delta. As the stock goes higher and this goes in the money, the delta is changing from 50 to 60 to 80. And as the stock moves lower, the delta is moving rather quickly from 50 to 40 to 20. But once it gets to either side, either deep in the money at 100 delta or deep out of the money at 0, all of a sudden the changes in delta are reduced significantly and there's very little change. So at the money, you're going to see great changes in delta. And when you get out of the money, you're going to have very little changes. And this is magnified when you have an option that is expiring near term or close to expiration. There's a phrase or a term you may be familiar with called exploding gamma, and you can look that up and read more about it. Exploding gamma is this effect close to expiration, if the stock's moving, that the delta might be changing between 0 and 100 and 0 and 100 and back and forth, and just have this tremendous changes in your delta position close to expiration and at the money. Now, a lot of investors are not going to use gamma a whole lot. There's a lot of information contained in the gamma position. If it's your first time hearing about it, hopefully some of that was absorbed, but going through and reading more and more about gamma, if you're interested, certainly can provide you some information, and I'll tie gamma in as we move forward. Now let's go to something maybe a little more simple that people are more familiar with, and that's going to be the theta and Vega. First of all, theta, it's the options sensitivity to time. Investors realize options decay from one day to the next. That's just the way they operate, and there is an expected amount of decay that you can look at and forecast as that option goes from one day to the next. With the passage of one day, the cash amount that the option is expected to lose. And here's an important point. This is usually expressed per calendar day, not trading day. And that's important. There really is 3 days of time decay that comes out of an options contract over a weekend. Some investors will say, I like to sell options on Friday afternoon because I get 3 days of decay come Monday morning. And that is true. I'll just have a few comments about that. It's not as easy as it may seem. First of all, and I'll go back to my professional trading days, everybody knows when weekends are coming up. And myself, when I was making markets on Friday morning and Friday afternoon, if the market was relatively quiet, not a lot was going on, and I was using pricing models to forecast theoretical values, and that helped me develop my bids and my offers. Well, on Friday, I would start to take out the weekend and drop the days to expiration by 1, 2, or 3 hours before the closing bell on Friday. And that started to adjust my theoretical values. And at some point, I might be providing an investor with a bid and an offer that was more reflective of Monday morning than it was Friday afternoon. So you may not be getting those 3 days of decay that you thought you were getting. Also, what I'll say about that is you really are taking 3 days of risk. Oftentimes, or at least there are some examples of something happening over a weekend. Of course, macroeconomic events can occur, political events, virus events can occur over the weekend. And come Monday morning, you may already have a big move. You have 3 days as opposed to just the 1 day where something can happen anywhere on any level that affects the market. And when you sell options on Friday, you take that risk of more time for something to happen to drive the markets in one direction or another. And then calls and puts both have negative theta amounts. All options, whether they're call or puts, are going to decay every single day. And the amount of decay somewhat depends on the moneyness status. First of all, in the money options, and this is looking at an option that is over time. As we approach expiration, how much does it decay? You have this in the money option, and of course out of the money is also consistent with this, with very little extrinsic value or time value. The decay is more linear. And this is because in the money options specifically approach parity, and that small amount of time value decays rather slowly and in a linear fashion as you approach expiration. But what most people are concerned about are at the money options or near at the money options. And you have certainly a different looking rate of decay. Now, where this arrow hits, I haven't specified a time here because it's rather subjective. You may hear different numbers from different instructors, but somewhere around that 40 days to expiration is where this arrow is, around there, 30, 40, 50 days is where the time decay starts to accelerate, and it continues to accelerate all the way through expiration. The fastest rate of decay is going to be the last week or even the last day of expiration. Now, from an option buyer's perspective, why would you want to buy an option that's decaying this fast? Well, it's because the premium's low. And you may think it's worth your while. If you're expecting a move in the stock to occur, it might be worth it to buy an option for a relatively low amount, accepting the fast rate of decay and looking for a move in the stock one way or the other. On the flip side, sellers love this fast decay, but as you get really close to expiration, it might not be worth selling an option for a dime or a quarter or even a $0.50. If the option is accelerating quickly, but the premium isn't there, then you may need to go back further in time. So finding that good spot, that sweet spot for you of when, from an option seller's perspective, when are you getting enough premium to make it worth your while and sit on a good spot on this curve. And buyers have a different objective. Some like to avoid this area here and either buy before or after, but buyers are somewhat speculating on a move, and your market analysis and when you think that move's going to happen and what magnitude is that move going to be, that helps option buyers select expiration dates. But time decay for most of the options traded is not constant. Now, volatility, I promised to get to volatility for sure. I'm going to, but volatility, implied volatility is not a Greek. Vega is the Greek, which represents an option value's sensitivity to changes in implied volatility. Specifically, when implied volatility moves by 1%, what will the change in the option price be? And of course, all factors remaining constant. Well, that's not going to be the case. But something that's a little more intuitive, calls and puts both have positive Vega amounts. If implied volatility increases, both call and put prices go up. And if implied volatility decreases, both call and put prices go down. Translating that into positions like I did with some of the others, if you buy options, you are buying volatility and you have a long Vega position. If you are selling options, you have a short Vega position. Now, the one comment, I thought I was going to bring gamma in here a little bit. Now, gamma, if you're trading a large position, you have a lot of options, gamma is useful because it can tell you if you're long or short options. You have a good idea whether you're long or short options. Now, if you know that, let's say you're long gamma, well, you have a pretty good idea that you're also going to suffer from time decay because you're long options. You'll also have a pretty good idea that you're long Vega and you would profit off of moves higher in implied volatility and you'd suffer from moves lower in implied volatility. And if you're long gamma, you also know where your deltas are headed. If the stock moves up or the underlying moves up, you know your deltas are going to increase for you. And if the stock moves down, you know your deltas are going to move down for you. So gamma gives you some insight into all of the other Greeks, and none of the other Greeks themselves give you that much insight into the others. That's my comment about tying these all together. But I want to keep going with volatility. Certainly, implied vol is considered the most influential price factor. It's constantly changing. Back to my trading days, I was using theoretical values to set bids and offers and help guide the markets that I was making. But as a professional, you're not trying to make money because of a directional move or have an opinion on volatility. I was trying to capture the bid-ask spread and get that edge, as we called it, on the trading floor. What that meant is I wanted all my Greek positions to be flat. Delta, gamma, Vega, Theta, I wanted all of them to be flat or as flat as possible. I did not look at my theoretical values as correct or gospel or valid, and this is what they should be. I was changing them as the market dictated to me. So as bids came into the marketplace, if I felt like I needed to raise my market, all I did was go in and tick up my implied volatility assumption that was being used in the pricing models, resubmit, and get new calculated option theoretical values at a higher implied volatility level. If there were more sellers coming in, if brokers were coming into the pit selling options left and right, well, then I'd go in and lower my implied volatility assumption, driving my theoretical values lower and lowering my bids and my offers. The point is, implied vol is changing constantly throughout the day. It's driven by supply and demand, and it's moved to fit option prices that you're observing in the marketplace. Some investors, some money managers may compare the implied vol of the open market price to the implied vol that they think the options should be trading at and form an opinion and trade directionally. That's certainly valid. And I did work on a trading desk that did that, traded volatility all day long by analyzing today's value of implied vol versus historical averages and determining whether or not implied vol should be bought or sold. But it's changing all of the time, and it's a great uncertainty. Usually, market declines are associated with increases in implied vol, and rallies are associated with declines in implied vol. That's not a rule. It doesn't have to be that way, but usually that's the way you see it. But keep in mind, changes in implied volatility do not require changes in stock price. The simplest example I can give you is just maybe a company announces a surprise press release, or there's changes in the dynamics of the business, or the changes at the board of directors level. All sorts of things can occur that leave the future stock price movements in greater uncertainty, change the implied volatility level. It doesn't have to be attached to a change in stock price, but it is changing all the time. When you're trading options, it's not necessarily true that you have to have an opinion on implied volatility levels, but it certainly is at least very valuable to know what was the implied volatility level of the option when I bought it or sold it, and then track that. It'll greatly help you understand the changes in option price as they occur, especially if they don't seem to match the changes in the stock price. Now, taking another step back, I want to define a few things. Historic versus implied volatility. They're two very different things. First of all, let me put up the historic volatility. This is looking backwards. Historic volatility looks back at past price movements in the stock. It's a calculated number. It is factual, and you can use historic volatility levels to predict future or implied volatility levels moving forward. You can also isolate what type of historic volatility do you want to look at. Is it a 30-day historic volatility? Is it 90 days? You can choose what you want to use and then try to determine where you think implied volatility levels should be moving forward. So while historic looks back, implied looks forward and is used to price the options contract. Implied volatility is also defined as the volatility level that justifies the price of an options contract, and it is the forecast of what future volatility of the stock price will be specifically between today and expiration date. So historic looks back, implied looks forward. You can use historic to get an opinion on what implied should be, but know that looking forward is certainly going to be difficult, and there will be a level of uncertainty. I just want to say a few words about Rho. It is a first order Greek. It's very important to pricing models, but it's not something investors generally track every day. Rho represents the expected change in the option value as the interest rates change by 1%. And that's one reason why it's not something tracked every day. You don't get 1% rate changes too often. It's going to be a fraction of that. And also in today's environment, these changes in interest rates are predictable. They're forecasted. We know when Fed meetings are going to be, and the changes in rates are something that the market starts to price in way ahead of time. So while it's important to know that Rho exists and you can look for these values, tracking it on a day-to-day basis is not something that investors often do. The only interesting thing here that I'll point out about Rho, just from an educational perspective, as interest rates go up, it has a positive effect on call prices. I think from a conceptual perspective, it's easiest to understand this. If you buy a call option, it means you're not buying shares of stock. You're keeping a lot of cash in your account, and that's maybe why you're buying the call in the first place. If interest rates go higher and you can earn a greater risk-free rate on the cash you're holding in your account, then that call option becomes a little more valuable to you. You're more interested in buying calls than you were before, because you can earn more money on the capital you keep in your account. Puts have negative Rho. Remember, puts provide the investor with the right to sell shares of stock. If you can earn more from the risk-free rate, then it's a little more valuable to you to sell shares or sell the underlying and get that cash in your account. So calls will move higher as rates move up, and puts will have lower. And then, the greater the premium, the greater the effect. So in the money options, long-term options, that's when Rho is at its greatest. So that's all the Greeks. So we tied really three pieces together: supply and demand, where prices really do come from, is market participants, bids and offers from everybody. Pricing models are very important and very useful in estimating what you think a theoretical value for an option should be, or forecasting what future prices of the options can be, changing the variables. And then you have the Greeks. The Greeks help understand price movements, and they help you get a better understanding of how the positions and the prices in your account are changing. There was a lot there. And here's another summary page where delta and gamma are kind of tied together. Delta changes in the stock price, gamma, the changes of delta themselves, and then you have theta and vega and rho. Now, the Greeks can be daunting. People might say, well, wait, that was a lot of information. That was just too much to absorb. But the more you hear it, the more you become familiar with it. And when you really look at this, considering Rho is not something that a lot of investors are going to track closely, there's only 4 Greeks to really know. Now, there's second order and third order Greeks. You can get really into detail with this, but here there's only 4 pieces to get to know. And I think if you absorbed a lot and understood a lot that I went through today and do a little more digging, then you really can get your hands around each of those 4 Greeks. We got more information on our website, and there's the contact information again, optionseducation.org, the investor services team by email, options@theocc.com. Check for our events on our website, the upcoming webinars that we do, and our social media contact info there. And so now, Michael, turn it back to you. Michael, are you with us?
Yes, I am. I'm sorry. I was having
There
a
it is.
little trouble with my mute button there.
No problem.
Yes, I am with you. Thanks very much. That was fantastic, as always. Thanks, everybody, for joining us. Ed will be with us again next month. You'll be getting some notifications about that event. So definitely pay attention to the TradeStation calendar and our emails. And we'll see you all at another upcoming TradeStation event. Thank you very much for attending. And once again, thank you very much, Ed. It was really great having you.
Thanks for having me. Look forward to the next one.
Thanks, Ed.